The second financial statement we're looking at in this module is the balance sheet. It captures information relating to business assets, liabilities, and equity. To illustrate how a balance sheet is laid out, we'll look at the example of Tom's plumbing business. To start with, we should list his business assets. These include a commercial van, a set of tools, a laptop to handle invoicing, and cash in his business bank account. Using this information, we can now create our first column on the balance sheet for assets. Let's now have a look at his liabilities. To help afford some of his business equipment, Tom has taken on a bank loan. This information forms the second column in the balance sheet. Finally, let's have a look at equity. Tom is the only shareholder in the business and has contributed some of his own savings into the business over the last few years. This amount is called issued capital. In addition, Tom might have also decided over time to keep some of the profits that the business has earned in previous years and hold it in the business. This accumulated amount is called the retained earnings. Using this information, we can now add a third column to complete the balance sheet. What you should be able to see is that assets minus liabilities is equal to equity. If this is not the case, then there has been an accounting error. So the balance sheet conceptually is quite simple from what we've seen. Where it becomes more complex is where you have other items. Let's identify a few. Let's say Tom has customers who have delayed making payment for work completed in the current year. No cash has been received, but because an obligation of payment has been created, an asset can also be recognized. In accounting, this is called accounts receivable. On the other hand, Tom might have also purchased equipment from suppliers, but delayed making payment to them. This is recognized under the liabilities column as accounts payable. There are aspects to Tom's business which have intangible value too. This includes things like his brand and established relationships with customers. These can be tough to put a financial value on. However, Tom may decide to estimate a value. This would be placed as intangible assets on the balance sheet. Another complexity could be if Tom believes that some of his customers that owe him money may fail to pay him in the future. An item might be created for this under liabilities as provisions. This covers the basics of a balance sheet. It is a financial statement that captures the value of assets, liabilities, and equity at a single point in time.